Hello guys, welcome to the video. I am Sarvesh Kutti. In this video, we are going to discuss about why having a multi-asset portfolio is very important in 2026 and the silent wealth killer, which is portfolio concentration. Okay, and why your safe investments are riskier than you think. Before starting the video, humble request that if you are interested in personal finance or wealth creation, then please do subscribe to our channel and hit the bell icon as well. We bring such insightful videos on wealth creation, tax saving, and personal finance on a regular basis. Also, if you are an investor in any of the financial products, whether it be mutual fund, SIF, PMS, AIF, etc., or planning to start your investment journey, you can book a free investment portfolio review and guidance with me online. This is absolutely free. There are no hidden charges or no product pushing from our side. We will help you to identify your and your family's financial goals, and based on that, we will provide you guidance on which products can be the most effective for you to achieve those goals over the years. Okay, so let's start the video. So the most overlooked risk today in Indian wealth in 2026, it is not picking the wrong stock, it is not bad market timing, but the problem is having a large concentration risk. The inevitable truth is that every single asset class, whether it be equity, gold, real estate, goes through a lost decade or cycles where they underperform for sometimes 5 to 10 years. So the modern solution is to have a multi-asset hygiene in your portfolio. This should be the standard norm. Now, the current reality is that most of the Indian households have 70 to 80% of their wealth logged into real estate. So the problem is that the money is locked in real estate and there is no liquidity. And there is a lot of issues with Indian real estate as well. But the households are having an illusion of safety. That is the illusion of solid brick and mortar investment. The vast majority of Indian household wealth is locked in physical property. So here are four hard truths about your real estate concentration. First and foremost is illiquidity. Okay, you cannot sell 5% of a bedroom to fund a 30 lakh rupees emergency. That is just not possible. And illiquidity is something that I have seen in many clients. In spite of having crores of rupees of real estate, when they don't have liquid asset, they fall into debt or they fall into financial crunch in spite of having real estate of crores of rupees, because they cannot sell it at the time of the emergency or at the time of an opportunity or at the time of crisis. Okay, so the illiquidity aspect is something that most people overlook, but it is actually extremely crucial. Second thing is extreme concentration. As I said, most households are holding 80% of their net worth in a single property or multiple properties, and that too in a single city itself. Not just in a single city, most of the people have their properties in a single neighborhood. Okay, so that is the definition of a uncompensated risk. The third problem with this is that there is a terrible yield to real estate investments. I made a video 2 or 3 days ago about why real estate is one of the worst investment in India. If you are buying real estate just for the sake of earning rental income, of course, if you are buying a real estate for the sake of your own consumption, if you want to stay there or run a business, etc., that's fine. But if you are purchasing real estate to earn rental income, then the yields are extremely terrible. The rental yield today in Mumbai is around 1.5 to 2.5%, and a basic fixed deposit will pay more than this with zero effort. Okay, now the fourth problem with the real estate investment and concentration of wealth is the survivorship bias. The narrative that property will always go up or the price of property will never go down. Actually, this is a very wrong notion actually, but this has been carefully curated by the builder lobby, etc., to lure the retail investors thinking that the property prices never go down. But property prices have gone down and property prices have stayed stagnant for almost 7 to 10 years in some of the areas of at least Mumbai, as of what I know. Okay, maybe this could be true in other cities of India as well. Okay, then now you can see what is happening in Dubai. People have invested crores of rupees in Dubai, but today, unfortunately, because of the situation that is happening over there, can you imagine the kind of crash that the property in Dubai market might happen? I'm not saying it will happen. I hope that it doesn't happen, but what if it does, right? So this kind of concentration risk is something that people are, looking at in Indian households. Okay, then we need to see that the next problem is that how guaranteed returns guarantee wealth erosion. Why there is so much fascination of fixed deposit FD culture in not just people who are from the 70s or 80s generation, but even young people. When I talk to the second generation of our clients or the new investors that have come in, they are so what do you say, sold into the concept of guaranteed return, that they are not looking at proper asset allocation. Of course, a fixed deposit, or I would not favor fixed deposit, I would rather say a fixed income mutual fund or an arbitrage fund or a liquid fund is essential. Why? Because that is something that you need to have for your liquidity needs or your short term goals needs. But just having all the money stuck in fixed deposit is a very very bad thing. So the hidden math of a standard fixed deposit in April 2026 is that familiarity is being confused with safety. Now look at the gross FD rate is around 7.5%, if you look for senior citizens, etc. And the post tax haircut is around 30%, assuming the person is in 30% tax bracket. So that will be around 2.25%. What remains is around 5% approximately, and this is the silent erosion of inflation. So inflation, real inflation in India is around 7% to 8%. So if you are getting around 5 to 6% in hand in an FD, and then if the interest rate goes down even further in the future, so you also have to deal with the reinvestment risk in an FD, right? Which means that you are actually losing around 1.5 to zero point 0.7, sorry, 0.5 to 0.75% per year in terms of your purchasing power, right? Now just imagine if somebody was retired in let's say the year 2000. Okay, at that time the person was say 60 years old. Today the person is 85 years old. In 2000 they got say around 15 lakh rupees, and they kept on investing that money in FD. Of course, time and again they would have needed to draw down on that particular FD amount, withdraw some amount for their personal expenses, medical expenses, etc. What is the purchasing power of 15 lakh rupees today? It is very less for at least a person who is 85 years old. One unfortunate event of hospitalization can wipe out around 8 to 10 lakh rupees if there is a major surgery. So imagine if somebody is just relying on fixed deposit, what can be the future? And in future, the interest rates are going to keep going down, not going up. Okay, so you're not just, basically you're not building wealth, you're barely treading the water, you're just trying to stay afloat, but in the long run that will not happen when you have all the money in your FD. Now, let's look at the high performance engine, which requires a seatbelt, which is equity. So, equity delivers unmatched growth, that is absolutely true. But pure exposure to equity only leaves you entirely at the mercy of the market timing. So, what do the pros do? Historical, returns on Indian equities at least has been around 13 to 14% CAGR over the last 20 years horizon, right? So the three hidden risk in equity is, first thing, that the equity investments need to be done for 5 years and above investment time horizon only. I have seen in my portfolio reviews people want to invest say 10 lakh rupees or 20 lakh rupees for their children's education 3 years from now, and they have bought small cap funds. All of the money is in small cap funds. I mean, it just doesn't make sense at all, right? And if let's say there is a 20-30% correction in 2-3 months, which is very much possible, that has happened in 2020 20. Okay, that has happened in 2024 large cap stocks. That has happened in the recent Iran and US conflict, Israel conflict. In the last 1 month, small caps have fallen by around 30-35%. So what is the logic behind investing a short-term goal, and that to a very crucial goal of children's education, to put that money with less than 3 years horizon in small cap stocks? So that doesn't make sense, right? So the three hidden risks for equity investing is severe volatility. As we all know, can your portfolio actually handle a 38% drop in just 30 days, as that it was seen in March 2020 in some of the mid cap and short cap stocks, small cap stocks, right? Second is the sequence of returns and risk. So a market crash occurring in 1 year of retirement can permanently destroy a 20-year financial plan. Okay. Third thing is the home bias, which means that most Indian investors own 0% international equity, and they deliberately are ignoring 97% of the world's opportunity, including opportunity like Apple stock, Microsoft, Nvidia, etc. So what this point basically is emphasizing on means that even though people have equity exposure, they don't have exposure to international equity, which means that they have a geographical risk as well. The next thing is that treating portfolio insurance as a strategic asset, right? So gold is not a primary growth engine, it is a highly specific defensive mechanism. In the past 1.5 years, people have kind of lost the meaning or understanding of why there should be gold in the portfolio. In fact, when people are realizing that there should be gold allocation in the portfolio, they are just realizing it out of FOMO, right? And there were so many people who just jumped onto the gold when the gold prices went up by 100-120%. A lot of people jumped onto silver when silver went almost 2 to 50% up in the last 1.5 years. So that doesn't make any sense, right? So gold should have a purpose in your portfolio. So the purpose of gold is that it thrives exactly when everything else fails, which means that if there is an inflation spike, if there is a war, if there is currency devaluation. Now, there has been an exception in the recent Iran and this Israel conflict, that gold was also falling and equities were also falling. The reason for that was very simple, that the central banks around the world were buying a lot of gold. But what happened is there was a lot of rally in gold in the last 1.5 years, right? So there was profit booking in gold as well as in silver as well as in equity during this conflict. But in normal times, in not normal times but normal scenarios, gold does act as a buffer for your portfolio, and it has acted so in the past and it will do in the future as well. Okay, so what is the downside of having large amount of allocation to gold? A lot of women in India have gold as their only asset, right? So what is the downside to it? It can move entirely sideways for 5 years at a time. For example, in 2013 to 2018, for 5 years, gold gave absolutely zero returns. Then the allocation limit. So there has to be a strict cap of 10 to 15% of your total portfolio for gold. Some people have 2-3% allocation, which doesn't make any sense. Some people have 40-50% allocation. Again, that is too much concentration. So there has to be a limit of 10 to 15% of portfolio allocation to gold. Then the instrument shift. Stop buying jewelry for investment purpose. This is a big thing. A lot of Indians believe that buying jewelry is actually investment, but jewelry is just a consumption product. It is not an investment. When you buy jewelry, you pay upfront 10% to 12% making charge. Then you pay GST on that, and then you also pay GST on the gold, 3%, 12, and 18% on the making charge as well. And when you try to sell it back, let's say if you want to sell it back, then they will deduct that particular making charges from you, and deduct the melting charges, etc., and all that. So jewelry is not an investment, it is a consumption product. So if you think that you have made a lot of investment just because you have bought a piece of jewelry, I don't think that is a sensible way to assess your wealth, right? So transition to sovereign gold bonds or to gold funds to capture a 2.5% extra interest rate. So that's in SGB, but now SGB has stopped this for the secondary market. Okay, but and SGB new issuance is also stopped from the government. But I think gold ETF is also a very good option if you want allocation into gold. Okay, so the mathematical magic of asset correlation. The goal is not just high returns, the goal is reducing volatility without sacrificing returns. So, what is the definition of asset correlation? Correlation is the strategy of owning assets that move in opposite direction. This gives the buffer effect. When equity crashes, gold often rises. When gold trades flat, equity carries the load. So, this is how the curve of a properly, managed multi-asset portfolio can be seen, or the equity curve can be seen over the years. Okay, now structuring your wealth across 3 phases of your life. So this is a sample multi-asset architecture designed for 2026. Okay, of course, this is not an investment advice or a generic advice for everyone. Everybody's financial situation, age, etc., and life situation is different. But this is just like a glimpse of what can be done. So this is asset classes, age, and we will see how we can allocate as per the age. So for age 30s, in your 30s, you need to have equity 70%, and out of that 70%, there should be 30% international exposure. In debt, you should have around 15%, in gold around 10%, and REITs around 5%. So this will give you some commercial real estate exposure as well. For people who are around 45 to 55, there needs to be balanced portfolio. So equity can be 50, debt can be 30, gold can be 15, and REIT can be 5%. And for retired people who are now on the wealth preservation mode, their equity allocation can be around 30% or even 20%. Debt should be around 40-45%. We can also put 20% in a balance hybrid fund, right, which will balance both equity as well as debt dynamically for them. Then gold ETF should be around 15%, REIT can be around 10%. Okay, so the question is now, are you still silently leaking wealth? So review the top 5 multi-asset mistakes currently dragging down high net worth portfolios. First is fake diversity, believing that I have FDs and properties is a and they think that it is a diversified portfolio, but the reality is both are defensive and illiquid assets. Of course, FD can be a little bit liquid, but again, it, as I said, it doesn't match the inflation. Mutual fund clutter. Owning 10 different Indian equities funds is not diversification, it is just a massive overlap. Okay. Ignoring the world, operating with 0% international exposure. Thinking jewelry as an investment and paying 20% making charge guarantees an instant loss on day one. And no rebalancing means failing to sell your winners to buy your laggards at least once a year, which means basically no rebalancing based on your change in age or change in financial or life situations. Okay. So stop guessing and start engineering your wealth. That is the only answer. No single asset class is perfect, but a structured portfolio properly created together, they become entirely anti-fragile. So claim your 15 minutes, claim your free 30 minutes portfolio audit. Okay, so what is this portfolio audit? What we do is basically, you will find a link in the description box below. It is a Calendly link. You have to click on it. There will be a few basic questions that it will ask you. It is for us to understand about your situation before we hop onto a call, and then you have to essentially select the time and date on which you want to book the call. In the call, we will first understand what is your current investments, and then looking at your financial goals or your family's goals, we will create goal baskets for you, which will be customized for you, and those goal baskets then will be mapped to products or financial instruments which will be helping in achieving your goals. Okay, for example, if somebody is 40 years of age, earning 2 lakh rupees a month, married wife is let's say housewife, and they have one son who is around 16 years old, and this guy is 40 years old, so he has 20 years for retirement. He wants to send his son to, let's say, US in the next 7 years, and he also wants to buy a house in the next 10 years. So he has three goals. Based on these three goals, we will see which investment we need to put in what basket, so that we can start his SIP, start his lump sum investments. The aim is to make sure that all these three goals are achieved in the time horizon that they have to be achieved. So this is what we do in goal-based investment planning, and this is customized for each and every client. It is not the same for everybody, because, as I said, everybody's financial and life situation is different. So what we will deliver is an immediate identification of your concentration risk, a precise risk assessment calibrated to your specific age, a balanced multi-asset roadmap which is structured for 2026 and then beyond for the next 5, 10, 15, 20 years. So we'll see a link like this, calendly.com/Auris Wealth. Click on it, fill the form, book your time and date for the consultation, and this will take not more than 2 minutes, and your slot will be booked. There are limited slots, so make sure you do it as soon as possible. Also, if you like this video, do give it a thumbs up, and also ask your questions in the comment section below. We will be more than happy to answer them, and also subscribe to our channel so that you will keep on getting these kind of videos on wealth creation, personal finance, etc. on a regular basis. Thank you so much for your time. Have a great day.